You know, if I were to ask you to guess a stock that has rallied more than 175% over the last year, a big company with a well-known brand, maybe you'd guess it was a technology company. Would you guess it could be an airline like United? Well, that stock has had a huge run in the past year. It's up in the pre-market after the latest quarterly results. And joining us to talk a little bit more about that carrier and the trends in the industry is Trent, who tracks the airlines as part of the Citi Research team. Great to have you with us, Stephen. Thanks for your time.
Oh, good morning. Thanks for having me on.
So United shares set for a takeoff again today. What has the company been doing right in the eyes of investors?
Yeah, absolutely. So I think the first thing where you see the network airlines really distinguishing themselves from the discount carriers is the amount of revenue they generate outside of main cabin. So the segmentation of the cabin, United has been front and center, developing its Polaris brand. And I also wouldn't forget the ancillary revenue, the co-branded card flow, and loyalty program revenue. These are the things that are really hot right now, combined with what looks to be continued strong international flow, thanks in part to a resilient U.S. dollar.
So does that mean, because I think coming out of the pandemic, we heard about people having that great desire to travel. And first it was kind of more of a consumer story, but increasingly people got back to work or back to traveling for business. And if you've got a big brand like this company does, you have options, you can create sort of different tiers and premiums, and it's showing up in the numbers?
Yeah, absolutely. And not only that, but what the depth and breadth of goods and services you can offer your customers. The co-branded card, economy plus, business class, domestic first class. There's just a lot more options you have with the network airline. So we did see, coming out of COVID, for example, a furious recovery of passenger demand, and the industry had a little bit of trouble keeping up with it. But now it looks like there are some structural items in terms of who's flying and when they happen to be flying, and how they decide to pay for it, along with the add-ons related to co-branded card. All of these factors, structurally speaking, really benefit the network carriers. Okay,
and Stephen, you're generally constructive not only on a United but on American Airlines, on Delta. What would be the other things that people have to think about? Only because, you know, I hate to say it, but with the airlines, they have an interesting history for investors over the long term. What are the wild cards to think about with this sector? Yeah, so I think certainly we're still talking airlines, so there are many exogenous factors that can have an impact, unfortunately. But when we think about the long-term story, this group today is not the same group that it was 25 years ago. There's very little to no synthetic jet fuel hedging among the majors. So if you go back to the credit crunch, a lot of those losses were related to fuel hedges. There's now a great deal more co-branded card revenue and broader co-branded card remuneration and cash flow than there was before. So I'm not going to say that these businesses are now consumer companies, but they certainly look and smell more like consumer companies if you look at the profile of their cash flow and their earnings quality. So I think as we move forward, we look at names like Delta or American Airlines, for example, and we do have elements of the market that have not come back to this space. So although United remains our favorite, we've got American Airlines on our focus list because we think that one is the place where there could be upside surprises because it's not the sell-side consensus favorite as are the other two. Okay. Stephen, good to get your perspective. Thanks very much as always, Stephen.